Metrics family, welcome to Moon Mission, and today we're going to talk about asset allocation in crypto and where it's going. This is the new trend, and for the first time, we're seeing crypto mature right before our eyes and become a great opportunity not just to make money, but to diversify and basically run away from inflation and getting into assets that have no correlation with inflation. What does that mean? Right? So if we go into legacy markets, as we see here, you basically have different kinds of asset classes. And with each asset class, you have asset classes that have a low risk or a high risk, which also gives you low returns or high returns. But in crypto, for the most part, prior to DeFi 2.0 and NFTs, we really only had just buying crypto. But if we go towards legacy markets, we have cash, we have bonds, we have real estate, we have commodities, we have luxury investments, and we have stocks. So in legacy markets, as an investor, there are so many different ways to diversify your portfolio. But what about a crypto investor? How do you diversify your portfolio as a crypto investor? Was it buying layer one chains, buying dApps? Now, for the first time, we're seeing mature categories in the space that let you diversify your crypto portfolio. Because going back into this chart here, looking at cash and cash equivalents, that's essentially stablecoins. Now you can go out there and earn yield on stablecoins. So for example, if we go to here Reddit, there's this post here that goes through and shows what are the best stablecoin yields in DeFi currently. This is about 2 months old, but it's a good overview in terms of how you can build a portfolio that models legacy markets, but it's all in crypto, right? So we'll walk through each and every single category here and see how we can do that in crypto. Because now, not only can you be all in on crypto, but you can be diversified, hedging your investments, meaning that you're taking on risk, but you're being rewarded for that risk. All right, so beginning with cash and cash equivalents, in crypto, there's so many different options available, right? So some of the ones I like personally would be Anchor on Terra Luna. This has been audited by us. So our team has gone through, did a code review on it. It scored over an 80, and it's probably the best stablecoin platform out there that I would probably use if I was buying stablecoins and trying to earn yield, right? So when you come here, looking at Anchor, they have $7.8 billion locked, right? So this has been battle tested. And if you go down here, their APY is almost 20%. Essentially, if you buy UST stablecoin and deposit here and earn yield, you can earn up to 20%. Where do you get that in legacy markets? Nowhere, right? So this to me is a great strategy for a bear market or just for having cash parked. Some of the platforms out there that seem to be pretty popular, USDC on Token. I looked at this today. This did not have the same APR, but Token is a pretty decent project. This scored over 80% on code review, so I do trust that. Anchor and Mirror, I trust that Mirror as well. Mirror scored pretty well in the code review. Ribbon Finance, this scored an 85 on our code review, right? So if you go to Ribbon, they have just strategy for USDC and ETH, and essentially it's been doing pretty well, right? So here it shows the yield is earning is 27%, right? So now, as an investor, we can walk through each of these different asset classes and start to build portfolios, right? So for me, cash equivalent is pretty straightforward. Stablecoin, yield farming, right? Now let's go to bonds. Bonds for crypto was not around until now. And no, I'm not talking about Hex, but I'm talking about all these Olympus forks. Olympus DAO, in my eyes, have built DeFi 2.0, which is essentially bonds, right? And why is this so big? Why did I sell all the assets in my portfolio for crypto that were not doing well for Olympus DAO and Time Wonderland? Because now we're taking on a lot less risk and earning lots of returns, right? Because we're so early with bonds and crypto that we're able to basically have high yield, right? Minus the risk. So coming here to Olympus, let me log, right? Looking at this, right? Olympus has $2.5 billion in total value locked. And 7,000% APY, 70x. Basically, 1 grand turns to 70 grand right now. And guess what? This is why I say this is a glitch in the matrix, because this will not last. Because this is meant to be a reserve currency. However, we're at that early that we're getting high yields without the risk or with minimal risk versus holding an altcoin that can drop 90% in value. We can hold a reserve currency that is not as volatile and pays us yield for owning it. So to me, this is such a huge win, but it will not last. Same thing with Time Wonderland. Time Wonderland has 714 million in treasury balance and has 81,000%. So basically, $1,000 turns to over $800,000. Now, obviously, that depends on if the APY lasts. However, right now, we have to strike while the iron is hot, and that's why I think these platforms are the new bonds of crypto. Right? So, for instance, looking at over here, so the best way to track how much money you're making on these platforms, I found is just to use Zapper.fi, and then look. So if I pull up Zapper.fi here, and let me pull up my Blockfolio. So this is what I have in Ohm, and this is what I have in Time Wonderland. Right now, if I compare versus what I invested, so in terms of Ohm, based on what I put in at the time, I had about 65K. It's now gone to 83K according to this. So I made almost 20 grand in like a week or two, week and a half maybe. And then in terms of Time Wonderland, I put in 25,000 or so, and it's now 36,000. So it's done pretty good. So obviously not like 100x or 10x per se, but it beats holding a shitcoin that's going to zero, right? Because right now we've been going through a bull market, and I had to really think long and hard about holding crypto assets in my portfolio that are underperforming in a bull market. Because once the bear market comes, they get super wrecked, right? So that's why, honestly, I got out of the projects, even though I like them. The fundamentals were not there after 6 months. From Armor Finance to Perp and others. I mean, the market is a market. I'm not saying they will never be good. I'm just saying right now, there's a glitch in the matrix, and the opportunity cost of holding a bag that is not doing well in a bull market is not good. Right? So, as a result, going back to this, right? Bonds for me, for crypto, are huge, right? Then going to real estate. Now, I've not bought any real estate in crypto, but to me, this is the metaverse, buying virtual land. Well, actually, I have bought some real estate. I bought a founder's plot in Treeverse, right? So Treeverse for me is more like a low cap real estate investing for crypto, right? But if we go to the sandbox, if we go to cryptoslam.io and choose the sandbox, this shows us the data of people buying land right now in the sandbox, right? So about half an hour ago, somebody bought land for about almost 15K, almost 15 grand. So land right now is going for over $10,000 in the sandbox. This to me is digital real estate, virtual real estate. And the reason this matters, right? I've got to pull up this chart, right? Looking at all these asset classes, we have to look at the correlation. Right? Because as an investor, we want to build a portfolio where the assets have no correlation with each other. Why does that matter? Because it makes no sense to hold an asset class in your portfolio if you have a different asset class that's also highly correlated with that, because you aren't really getting any benefit having both assets. So for instance, let's walk through this chart, right? So here we have, let's begin with S&P 500, right? So looking at the S&P 500, we see this is highly correlated with global markets, especially equities, but it's negatively correlated with currencies, right? So meaning that having S&P 500 and having currencies in your portfolio is a good hedge. Currencies are a good hedge versus the stock market, essentially, right? However, having this global and event-driven and even REITs they're highly correlated with the S&P 500. So not really a good move. Right? Now, so as an investor, you want to have different parts of your portfolio that don't have any correlation with each other, right? So for instance, a typical portfolio allocation would look like this, right? In legacy, you would have stocks, which would break down to small cap, growth stocks, large cap value stocks, international stocks. Then you'd have bonds, you'd have government bonds, high yield bonds. Then you'd have cash, money market, right? So cash are essentially stable coins in crypto. Bonds, Time Wonderland, Olympus Dow, right? Right now, they're basically high yield bonds, except in crypto, high yield is super high yield. Then we have stocks, which to me are basically cryptocurrencies. So basically, here, this small cap would be altcoins, shitcoins, large cap crypto. International would just be pretty much the whole market, in my opinion, right? And next, going back to this, right? So we have luxury investments, commodities, right? Commodities to me for crypto, this would be, I don't really think that we have commodities in crypto, but luxury investments to me looks more like art, investing in art, right? So for example here, this is a chart that shows a 25-year correlation factor for art and other asset classes, right? So in this case, we see that U.S. housing and contemporary art don't really have any correlation with each other, meaning that it's good to have them in a portfolio because if one is down, the other one won't really be affected, right? Then going to equities, global equities has a high correlation with the S&P 500. And then we have bonds. Bonds they do have a correlation with art, but not so much, right? Actually, it's negatively correlated, right? So bonds and art in your portfolio is good, right? So this is the way I began to view my portfolio. And now for the first time, we can do this in crypto, right? So art to me are NFTs, pretty simple, right? So for example, looking at Bored Apes, which to me is a blue chip NFT, although I have thought about selling it, but I had to think very, very hard about it because somebody made me an offer for 100 ETH to buy my Bored Ape. I bought it for 62 ETH about 4 months ago, but I didn't want to be that guy who sold a Bored Ape when in a year or two, or maybe down the road, it goes to like 1,000 ETH, right? Who knows? But for now, I'm choosing to keep my Bored Ape. But one thing I've noticed is the correlation of NFTs and Ethereum has been pretty much the opposite, right? Typically, when Ethereum is going up, people get out of NFTs to buy ETH, and when ETH is going down, people get into NFTs to kind of hold their value, right? So in a way, we're getting a hedge, right? So it makes sense to me to begin looking at your portfolio with different categories and asset classes, such as art being NFTs. And then last but not least, stocks are just regular crypto assets, right? So as an investor, as a crypto investor, it now makes sense. It makes a lot of sense to basically be involved in everything in crypto, right? So I'll walk you through my portfolio and what I currently have and what I don't have, right? So I'd have NFTs. I have Bored Apes and some other NFTs, but Bored Apes are probably the only blue chips I have for now. Stocks, like basically all my other cryptocurrency investments. Real estate, I bought a founder plot on Treeverse, which has done pretty decent. I think the highest it went was to a floor price of 3 ETH. But now, actually, I did mint their timeless characters, which will be characters in a game, in a metaverse game. So now I'm getting involved in real estate by buying that founder's plot and then minting art for that and then playable characters for that. Then bonds are essentially all these DeFi 2.0 bonding and staking platforms, right? Olympus DAO, Time Wonderland. Then cash, stablecoin, yield farming, right? This I don't really do right now. I'm only doing all these, right? But at a high level, that's the way I'm viewing my portfolio, and I think that's the future of crypto, right? Eventually, crypto will be so big, so drastic that this will be the new internet. This will replace legacy finance, right? So we're now building all these asset classes that we had in legacy finance, and they're now being migrated over into crypto. So as an investor, I highly recommend you look at the entire space now and get ready for a bear market. I'm not saying a bear market is coming now, but if it does, because markets do move in cycles, whether it's in 6 months, 6 years, who knows, because maybe we're going to a long-term super cycle. Because right now I do think I'm more optimistic for the bull run to continue. But regardless, though, I'm hedging myself, right? I've taken profits consistently during this bull run. And now I'm looking at my portfolio, and I've made a deep audit and gotten out of projects that are not doing well in this bull run. And then I'm finding projects that I think are good hedges for a crash that don't have correlation with everything in my portfolio, right? So that's the way I'm viewing my portfolio, and I think you should as well. With that being said, let me know what you think. And as we like to say, the moon is not the limit to the moon and beyond. Thank you.